Hello and welcome to the Alalibo Academy. In this video, we're looking at the progressive tax model. We want to understand what it is and why it is important, and especially in the West, where some of the countries have adopted this tax structure. All right, let's take a closer look. So we begin with the definition of progressive tax model, and it says here, a progressive tax model is a tax structure where the tax rate, the tax rate increases as the taxable base amount increases as well. Right, so let's stop here for a minute and take a closer look here. It says the tax rate, so let's put that here. So rate goes up, right? The base also go up, right? The base also go up. So again, there is an action and a reaction, right? There's an action and a reaction. The action is the tax rate as you make your money, and the reaction is the tax base, right? And you have to pay according to the rate that you're making. Now, the principal objective of this type of structure is to reduce the tax incidence of low-income earners, right? And shift that burden to of tax incidence to those that make a lot of money, those who can afford it, right? Due to high income. That's the principal idea of the progressive tax model, to ensure that those that earn lower income have lower incidence of taxation. In other words, they have less tax liability than those that make higher income. And the idea then is for those that make higher income to pay the higher taxes, and that money goes to support those that make lower income by giving them skills, training, capacity building, education in some cases, so that they too can earn living wages and be able to have savings and have hope for the future. That's the idea of this structure. So let's take a closer look with this graph here. So here we have taxation on this. On this side we have taxation, and on this side we have income, right? So let's say taxation begins at 10%, to 15%, to 20%, to 25%, to 30%, right? This is 30%. And then income goes from 50K to 100K to 125K to 150K. Actually, let's put here 75K. All right. So the idea then is, as income goes up, right? So at 50K, your tax liability is 10%. At 75K is 15%. At 100K is 20%. At 125K is 25%. At 150K is 30%. That's the idea, right? So as income rises, right? As income rises, your tax liability also rise, right? And again, you can see the spread from 50, 75, 100, 125, 150. So begins at 10% at 50K and ends at 30% at 150K. Now, the way it works is, if you're making 150K, right? The first 50,000 is taxed at 10%, right? It's taxed at 10%. The next 25,000 is taxed at 15%. The next 25,000 is taxed at 25%, right? And the next 25,000 is taxed at 30%, right? So in other words, if you're making 150K, you don't pay 30% straight up. For 150K, you pay 10% of the first 50, then the 25,000 between the 50K and the 75K is taxed at 15%. The other 25,000 between 75K and 100K is taxed at 20%, and so on, etc. That's the way it works. That's the progressive tax model. And once again, the idea is to ensure that those that make less money have lower incidence of taxation. That way they can have living wages and be able to build the capacity to move up the ladder. Now, some people say this is not fair because you're punishing those that make money, that work hard to make money. And they should be punished. And it's a disincentive for them to work hard if they're going to be paying more taxes. But others say, wait a minute, they're making all that money because of the support of those that are earning lower income. And without those that are earning lower income, they would not be able to make the higher income, right? So there are arguments on both sides. But this is a progressive tax model that is practiced in some Western countries. Canada, for example, has a very, very tight structure of this tax model, where the higher income Canadians pay more money, more taxes than the lower income Canadians. As you can see right here, once again, the higher income goes, the higher your tax liability is. That is the structure of progressive tax model.